It's Thursday, October the 5th. Welcome to the last quarter of 2023.
It's hard to believe this year's moving by so fast. Nice weather.
It is nice weather. Thus, the
sweater.
Jimmy Carter sweater.
The sweater.
So you can turn your heat down and put on a sweater.
We're going to tell you something that you already know. It's part of every conversation we have. It's a phenomena that has only occurred with Gibb and me, I believe we could say one other time in the 70s.
And we weren't I wasn't in the workforce in 1978 and 9, which
I just was at the beginning of it for me. So it was new, but we remember it and you remember it. And that is that the treasuries, 10-year especially, is now hovering at and is thought to be going to 5% or even
And when
higher.
You say the treasury, you mean the 10-year
The 10-year treasury.
It is a phenomenon that is it can be troubling. It's what's got the market over the last 4 weeks in a little bit of disarray because It's gone up so rapidly. And then there's something called a uninversion.
Right.
And an uninversion means the inversion that we've been living through, meaning whether it's a 2-year treasury or a 10-year treasury, you're going to get paid more for your 2-year treasury than the 10-year. And that is an inversion. It's usually something that is recessionary, but you can have an inversion and not have a recession, but it's rare. And an uninversion over the last 5 years. So in other words, it's correcting. In that correction, getting back to getting paid more for a 10-year than a 2-year. And when that occurs over the last 50 years, 100% chance of a recession. And we're in the midst of that right now.
And so what that does and what we see that it does, it creates conversations that we're having daily when it comes to money and money management for you, in that we can lock down both on a short term and we would not go more than a year. We'll talk a moment why we wouldn't go to the 10 years and lock down 5%. But at least for a year, why wouldn't we take advantage of getting that guaranteed 5+ and not worry about the volatility?
Which we've done over the last year in most of your portfolios.
And so that's being created now, and that's taking away from the stock market, both in performance and interest, to put new money in it. Now, the reason we would not go 10 years is because, think about this, and we talked about it last week. If you're going to invest, and let's just say 5% for 10 years, you're thinking in terms of 10 years, right? So if you then have to ask yourself, if I think in terms of the next 10 years with the stock market, do I believe I could get a higher rate of return even with the risk than a 5%? We would say, yes, the opportunity would present itself, so you should have some of that money invested in the stock market. So that's why we wouldn't jump into the 10.
No, because if you do get runaway inflation, let's just say that occurs, and we go back to the Carter years where it was 16% on a 10-year, then if you're locked in your money for more than a year, you're not able to participate in a higher rate of return, even though inflation is eating that money up. But it's going to be a much better situation if you have that money liquid to buy a higher yield.
So here is the discussion that we're having with everybody that we're talking to. Here's what we're thinking. Here's where we're going. And that is, we're here in October. We got the final quarter of the year. We got 2 Fed meetings coming up. We anticipate an increase in interest rate. We have money still on short term that's getting in excess of 5%. So let's go steady as we go. Let's get to those maturing dates. Let's see where these rates go. Let's see how it sets it up in 2024. And we might be buying for a year a rate in excess of 5% or higher, or we might be still building short-term ladders because
the last 4 weeks in the S&P 500 has been dismal. We've had 4 weeks in a row of markets dropping. I think the S&P has given back 6% of its gains. So if this is a precursor, then we're going to be very wary of it. But we just want to see what shakes out, because we don't think markets are going to solidify in the next 30, 60 days.
So remember this. Gib just said it is the S&P was down 6%. That's a 6% better buy for the future. Maybe it can be even better then. So that's what we're looking for as we go into this last quarter. There you have it. That's what we're doing.
And always remember, it is your money.
And your money matters.